imagine spending your whole life saving for retirement, doing everything right, you think, and then boom, a huge chunk disappears. Not from a bad investment, but taxes.
Yeah, it's this kind of quiet threat, isn't it? Something a lot of people don't really see coming until it's maybe too late.
Exactly. And that's what we're diving into today, the insights of Ed Slott. People call him America's IRA expert. He's known for making really complex tax stuff, well, understandable, actionable, even kind of engaging.
He definitely has a knack for that, cutting through the jargon.
So our mission here is twofold. First, understand why retirement savings are, well, kind of like a ticking time bomb, as Slott puts it. And second, more importantly, uncover his total solution.
All right, his strategy to basically defuse that bomb, protect your money from getting eaten up by taxes, keep it in the family.
Yeah, a simple, workable strategy. So get ready for some eye-opening facts and advice that might really change how you look at your retirement funds. Let's get into it. So Slott's main point, his core warning, is that no matter what kind of retirement plan you have, IRA, 401k, Roth, whatever, your savings are at risk when the tax man eventually comes calling it distribution time. He says it's not if you'll be taxed, but when, and crucially, how much.
And the why behind that is pretty straightforward, really. Most of the money in these accounts, it's tax deferred.
Meaning you haven't paid tax on it yet.
Exactly. So it's just sitting there, kind of a sitting duck for whatever future tax rates might be. And, looking at the country's finances, huge deficits, trillions added during the pandemic.
It seems likely taxes will have to go up at some point.
It seems very likely.
Right.
And historically, when the government needs more revenue, well, people who've saved diligently can become a target.
You mentioned history. Slott brings that up too, doesn't he? The history of tax rates.
Yeah, and it's pretty startling when you look at it. Income tax started back in 1913. Rate was just 7%.
Wow.
5 years later. World War I, it jumped to 70%.
70.
And then the baby boom years, 46 to 64, the top rate was over 90%.
90%. It's hard to even imagine.
Right. So today's top rate of 37%, with many people paying way less, like 10 to 22%. Slott calls these bargain basement prices.
And the warning is, don't expect these bargain prices to last forever.
Precisely. He uses this great golf analogy. Building your assets, saving up, that's the front nine. You get your lead.
Okay.
But protecting those assets from taxes when you take them out, that's the back nine. That's where you actually win or lose the game, financially speaking.
So higher future taxes are a big risk.
Yeah.
But you mentioned something else earlier. Slott talks about recent laws like the Secure Act, making things worse, like a broken promise.
Yeah, that's a really key part of his argument. The Secure Act first passed end of 2019, then updated with Secure 2.0 at the end of 2022. He says it actually derailed the plans for a lot of savers.
How so? What did it do?
Its biggest impact was basically killing off the stretch IRA for most people who aren't spouses inheriting an IRA.
Ah, the stretch IRA. That let beneficiaries spread out the withdrawals and the taxes over their whole lifetime, right?
Exactly. It was a fantastic tax deferral tool. Now, for most non-spouse beneficiaries, it's gone, replaced by a much faster 10-year payout rule.
10 years, that means much bigger withdrawals, much faster, and likely higher taxes each year.
You got it. Congress needed revenue, saw all this tax-deferred money sitting there, and, well, Slott says they saw it as low-hanging fruit.
And he finds the name secure ironic.
Very. He says it means exactly the opposite of securing your retirement, comparing it to things like the Deficit Reduction Act, which, didn't always live up to the name.
Okay, so we've painted a bit of a scary picture here. The tax time bomb is ticking. It sounds complicated, maybe a little overwhelming for listeners.
Wow.
How does Slott propose we fight back? What's the solution?
Well, his whole approach is about cutting through that complexity, making the rules easy to grasp so you don't get, as he puts it, decimated by taxes.
And this comes from his experience.
Yeah, 40 plus years as a CPA, thousands of seminars. He's distilled it down into what he calls his total solution. A strategy, he says, works for anyone with retirement savings. Doesn't matter how much you have.
Okay, let's hear it. What is this total solution? What are the steps?
It's a 5-step action plan. Pretty straightforward, actually.
Okay.
Step 1 is time it smartly. Basically, choosing when and how much to withdraw to manage those tax bills and avoid penalties.
Makes sense. What's next?
Step 2, secure it.
Yeah.
This means you got to update your plans specifically because of the Secure Act changes, especially around who inherits your accounts, your beneficiaries.
Right, dealing with that 10-year rule.
Yeah.
Okay, step 3.
Step 3, Roth it. This is all about using Roth IRAs. They're a really powerful tool for tax-free income later.
We'll definitely need to dig into Roths more.
Yeah.
Okay, 4.
Step 4, insure it. Using life insurance in maybe some ways people haven't thought of to cover future tax hits.
Interesting. And the last step.
Step 5, avoid the death tax trap. This involves putting together a solid IRA and estate plan that work together.
Okay, 5 steps. Let's dive into a couple of those. RMDs required minimum distributions. Slott says timing is everything here. Why is timing so critical?
Because messing this up costs you big time. They're this day of reckoning for your tax-deferred accounts called the required beginning date, or RBD.
That's when you have to start taking money out, whether you need it or not.
Exactly. And for most people now, that's April 1st of the year after you turn 73. Used to be 70 and a half, then 72, now 73, thanks to Secure 2.0.
And the penalty if you miss taking your RMD?
It's harsh. Slott calls it draconian. It's a 25% penalty tax on the amount you should have taken out but didn't.
25%. Ouch.
Yeah. Now, there is a correction window. If you catch the mistake and take the money out, you might get the penalty reduced to 10%. But Slott makes a key point. Your financial institution tells the IRS you were supposed to take an RMD.
So Big Brother is watching on this one.
Pretty much. It's really your responsibility to track this, and slipping up is expensive. There are a couple of narrow exceptions, like if you're still working and it's a company plan, not an IRA, and you own less than 5% of the company.
Very specific.
Yeah, or the end run effect clause if your account value tanks.
Yeah.
But generally, you got to take that RMD.
Okay, let's jump to step 3. Roth it. Ed Slott loves Roth IRAs. Calls them the tax deal of the century. What makes them so special in his view?
The absolute killer benefit is tax treatment. Money in a Roth grows tax-free. And then, assuming you follow the rules like the 5-year holding period, withdrawals in retirement are completely income tax-free for you and for your beneficiaries later.
No tax on the way out. That sounds good.
And there's more. Unlike traditional IRAs or 401k, Roth IRA owners don't have an RBD. No required minimum distributions during your lifetime.
Wait, so you never have to take the money out if you don't want to?
Never. You can let it keep growing, completely tax-free for your entire life if you wish. Then pass it on tax-free to your heirs. That's huge.
Okay, but the catch has to be paying the tax up front when you convert money from a traditional IRA or 401k to a Roth, right? People worry they'll lose growth potential by paying tax now. What does Slott say about that opportunity cost?
This is one of his most surprising points, maybe. He argues that opportunity cost is basically a myth here. The math works out.
How so?
Okay, his example. Take $100,000 in a traditional IRA. Let's say it grows 200% over time, so it becomes $300,000. If you pay, say, 30% tax when you take it out, you net $210,000.
Got it.
Now, take that same $100,000, convert it to a Roth today, pay the 30% tax, $30,000 up front, maybe from other savings. Now you have $70,000 in the Roth.
Okay.
That $70,000 also grows 200%. It becomes $210,000. But because it's a Roth.
It's completely tax-free. You still end up with $210,000.
Exactly. The net amount is the same. You didn't lose opportunity. You just shifted when you paid the tax from an unknown, potentially higher rate in the future to today's known, potentially lower rates.
That's a powerful way to look at it, paying tax on the seed versus the harvest.
Right. And he also talks about the widow's penalty or widower's penalty. When one spouse dies, the survivor inherits the assets, but loses the joint filing status and often gets bumped into a higher tax bracket. Plus, their RMDs might double if they inherit the IRA. So they face higher taxes on potentially less combined income. A Roth conversion done earlier could have provided tax-free income and avoided that pain.
Are there any downsides to Roth conversions we should mention?
Sure. The big one is you do have to pay the income tax up front. That tax bill is real and it's permanent. You can't undo a conversion anymore. And if you're under 59 and a half, you generally need to pay that tax with money from outside the IRA. Otherwise, the money you pull from the IRA to pay the tax could get hit with a 10% early withdrawal penalty.
Okay. And the 5-year rule for withdrawals?
Yeah, there's a 5-year clock that starts for each conversion to make the earnings tax-free. The converted principal usually comes out tax-free and penalty-free anytime, but the earnings need that 5 years. It's a bit fiddly, but manageable.
Good to know. Let's move to step 4. Insure it. Using life insurance. Slott calls this amazingly underutilized. He uses a sports analogy. Bill Buckner.
Yeah, the infamous error in the '86 World Series. One mistake overshadowing a great career. His point is, one mistake in retirement tax planning can similarly decimate a lifetime of savings. life insurance can act as a backstop.
How does it work in this context?
Well, the key is that life insurance death benefits are paid out income tax-free to beneficiaries. That's a huge advantage over taxable IRA withdrawals.
Okay, income tax-free. What about estate taxes?
It can also be estate tax-free if you structure it correctly. Usually means having the policy owned by and paid to an irrevocable life insurance trust.
So, potential double tax benefit.
Exactly. And it provides flexibility. Unlike trying to control IRA distributions after death with complex trusts, which Slott says often clash with IRA rules, life insurance paid to a trust gives you much more control over how and when beneficiaries get the money. Plus, it offers leveraged wealth transfer.
Meaning the death benefit is usually much larger than the total premiums paid?
Typically, yes. So, Slott talks about a life insurance replacement plan. You strategically take some money out of your taxable IRA, maybe just the RMDs, or maybe more, pay the tax on that withdrawal, and use the after-tax money to pay premiums on a life insurance policy.
So you're shifting assets from a taxable bucket to a tax-free bucket.
Precisely. You might use second-to-die policies too, which insure 2 lives, usually spouses, and pay out only after the second person dies. They're often less expensive and good if maybe one spouse isn't easily insurable. The key, again, for estate tax avoidance is usually not owning the policy yourself. Have the trust own.
So the goal is more, and less in taxes.
That's his mantra for it. More for you to spend now, because you're planning, more for your retirement overall, more for your family, and less going to Uncle Sam.
Okay, that brings us to the final step, step 5. Avoid the death tax trap with estate planning. Slott says your estate might be bigger than you think. Why is that particularly relevant now?
Well, estate tax laws are always changing. Right now, the federal estate tax exemption is incredibly high, over $13.6 million per person for 2024. That's more than $27 million for a married couple.
That sounds like it covers most people.
It does now. But, and this is a big but, that huge exemption is scheduled to sunset after 2025. It's set to basically get cut in half. So planning is still crucial, especially for people with significant assets.
And there's something called portability.
Yes, another key concept for married couples. Portability, technically DSUE, deceased spouse's unused exclusion, lets the surviving spouse use any unused portion of the first spouse's federal exemption. So a couple could potentially shield close to that $27 million currently.
And this is critical. Portability is not automatic. You have to file an estate tax return for the first spouse to die, even if no tax is due, specifically to elect portability. Miss that filing, and the unused exemption is lost.
Wow, okay, that's a potential trap right there. What else is crucial in this estate planning piece, especially related to IRAs? The absolute number one thing Slott hammers home is beneficiary forms. For your IRAs, 401ks, life insurance, these forms override your will.
Say that again? They override your will.
Absolutely. Your will might say everything goes equally to my 3 kids, but if your IRA beneficiary form only lists 1 kid or your ex-spouse from 20 years ago, that form dictates where the money goes, period.
That sounds like a recipe for disaster if you don't keep them updated.
Huge disasters.
Yeah.
Slott tells stories like Janice's sisters. Their mom left her IRA intending for all 3 daughters to share, but the form wasn't clear, or maybe only named one. The result: the sisters who weren't properly named ended up losing almost half the inherited IRA value to unnecessary taxes because of how it had to be distributed under the default rules.
So you need to be meticulous. Check those forms. Name primary and contingent beneficiaries. Specify shares like equally per stirps or whatever your intent is.
Exactly. Use an attached sheet if you run out of space on the form itself. Be crystal clear. Don't leave it ambiguous.
And what about using trusts as IRA beneficiaries?
Slott generally advises caution there. Traditional trusts often don't mesh well with the complex IRA distribution rules, especially RMBs and the Secure Act's 10-year rule. He uses a pig pen analogy, like the messy cartoon character, the trust rules, and IRA rules often conflict and create problems. Often, naming individuals directly or using ROGs or life insurance in an ILEAD are cleaner ways to achieve control after death.
The key takeaway here for listeners seems to be you have to do this planning now.
Absolutely. As Slott says, you can't leave this work to your beneficiaries because they won't be able to change much once you're gone. Your planning today directly determines how much the government gets versus how much your family gets.
Okay, beyond the 5 steps, Slott also covers potential pitfalls, right? Things that can trip people up even if they think they have a good plan. Practical stuff.
Yeah, he calls it the minefield of tax traps. Important things to watch out for.
Like what? Give us a key example.
The 60-day rollover rule. This is a classic trap. If you take money out of an IRA intending to roll it into another IRA or plan, You have exactly 60 days to complete that rollover.
60 days. Seems simple enough.
It sounds simple, but it's incredibly strict. And crucially, a court case confirmed this rule applies on an aggregate basis, meaning you can only do one IRA to IRA 60-day rollover across all of your IRAs within any 365-day period, not per account, per year.
Once per 365 days for all your IRAs combined. Mess that up, miss the deadline.
And the money you took out becomes a taxable distribution. Plus, if you put it back into an IRA after 60 days, it could be an excess contribution with penalties. It basically spells the end of that part of your retirement savings, Slott warns.
So how do you avoid that trap?
Easy. Use direct trustee-to-trustee transfers. Have the money moved directly between the financial institutions. Never touch it yourself. This avoids the 60-day limit entirely, avoids the one rollover per year rule, and for company plans like 401k, it avoids mandatory 20% tax withholding. Always do direct transfers if you can.
Good tip. Any other quick traps?
The pro rata rule. This bites people who have made non-deductible after-tax contributions to their traditional IRAs. They think they can just pull that after-tax money out tax-free later.
But they can't.
Not entirely. If your IRA contains both pre-tax and after-tax money, any withdrawal is deemed to come out proportionately from both. So if, say, 10% of your total IRA balance is after-tax money, only 10% of your withdrawal is tax-free, the other 90% is taxable. It surprises people.
Another complexity. What about using IRAs for things like real estate?
Slott generally warns against investing IRA funds directly in physical real estate. There are just too many landmines. The biggest are the prohibited transaction rules.
Meaning?
You absolutely cannot have any personal benefit or involvement. Can't buy a vacation home for yourself with IRA money. Can't lend money to your IRA. Can't personally guarantee a loan for the IRA property. It has to be completely hands-off, arm's length. Very easy to accidentally step over the line. Plus, things like calculating RMDs on illiquid property get complicated. He suggests real estate mutual funds or REITs within the IRA are much safer.
Okay, lots of traps to avoid.
Definitely. These are the kinds of things that can, as Slott puts it, legally rob America's savers of their nest eggs if you're not paying attention.
So wrapping this up, Ed Slott's message seems really clear. Protecting your retirement savings from taxes isn't passive. It requires proactive, informed planning.
Absolutely. You need to understand that tax time bomb. You need to look at implementing the total solution, smart timing, considering Roths, maybe life insurance, solid estate planning with those beneficiary forms.
And crucially, being aware of and avoiding those common pitfalls, like the 60-day rule or the pro rata rule.
Exactly. It all comes back to his philosophy. The vehicle you use doesn't matter, as long as you reach the estate planning promised land. Larger inheritances, more control, and less tax.
A great summary. And we'll end with Slott's slightly cheeky closing thought. Don't tell Congress, or they'll ruin this too. Let's keep these strategies between us. Food for thought for everyone listening. How can these ideas help you secure your own financial future?